6% in a single session. Silver just ripped through $77, and the catalyst that triggered it is the same catalyst that has been sitting underneath this market like a coiled spring for the last 10 weeks, waiting, building pressure, and today finally releasing with the kind of force that changes the entire near-term trading landscape for precious metals. The Iran deal, the Strait of Hormuz, the inflation trap that has been pinning silver down since February just got detonated. And if you do not understand exactly what happened today, exactly why silver moved the way it moved, and exactly what comes next now that the single biggest headwind in the silver market has been removed, you're going to misread what this move means, and you're going to misposition for everything that follows. That ends right now. Let's get into it. To understand why today's move is so significant, you have to understand what was holding silver down. Not in vague terms, not in general macro language, but with the specific precision that allows you to see today's breakout for exactly what it is. We covered this in detail in our structural bomb video on silver's decline from $121 to $73. The Iran conflict created what we called the paradox, a geopolitical event that should have been bullish for precious metals. As safe haven assets was instead suppressing silver through the monetary policy channel. Here is exactly how that mechanism worked. The effective closure of the Strait of Hormuz beginning in late February sent crude oil prices surging. Brent crude ran sharply higher as roughly 20% of global oil supply faced disruption. That energy price surge fed directly and immediately into inflation expectations across every major economy simultaneously. Inflation expectations rising means the Federal Reserve and every other major central bank faces a harder argument for cutting interest rates. Harder rate cut argument means nominal yields stay elevated. Elevated nominal yields combined with elevated inflation produces a specific real rate calculation that has been keeping precious metals in a suppressed trading range for 10 weeks. Silver went from $121 in January to the low 70s, losing 40%, as the combination of war hawkishness and the Iran inflation channel crushed the monetary case for holding non-yielding assets. And every day that the strait remained closed was another day that the inflation trap stayed intact and silver stayed pinned. Today, that trap was detonated. And the 6% rip through $77 is the first payment on a debt that has been accumulating for 10 weeks. Please hit that like button right now and subscribe to this channel because this is the real-time, analytically precise silver market coverage that this community gets first and gets right, and we are just getting into the full story of what today means. Let's talk about what the Iran deal actually is and what it actually does, because the word deal is being used loosely in some coverage today, and precision matters enormously for understanding how durable this silver move is versus how quickly it could reverse if the situation deteriorates again. What happened today is a ceasefire and framework agreement, not a final, signed, fully verified nuclear deal that permanently resolves the US-Iran standoff. The distinction is critical. A permanent resolution of the Iran nuclear program with verified dismantlement of enrichment capacity and full IAEA inspection access would be a structural and durable removal of the Middle East geopolitical risk premium from energy markets. That is not what happened today. What happened today is a cessation of active hostilities, a commitment to begin negotiating the framework terms, and critically, a signal from both Washington and Tehran that the Strait of Hormuz will be reopened to commercial shipping under some form of monitored arrangement. For energy markets, and through energy markets for inflation expectations, even a ceasefire framework is a massive development. Crude oil prices have dropped sharply on the news. Brent, retreating from its conflict-elevated levels, removes the immediate energy inflation impulse that has been feeding into CPI and PCE expectations. The inflation trap, the mechanism through which the Iran conflict was suppressing silver, despite everything the structural fundamentals were saying, has been detonated at its energy price route. And silver's 6% move today is the market immediately repricing the removal of that suppression mechanism. Now here's the specific analytical insight that separates investors who truly understand what today's move means from those who are simply reacting to the green candle. The Iran deal did not create new reasons to own silver. It removed the primary reason that had been preventing silver's structural fundamentals from being reflected in the price. Think about what that means precisely. For 10 weeks, silver has been trading at a level, the low 70s, that the physical supply and demand reality of the market does not support. The sixth consecutive annual deficit was confirmed. COMEX registered inventories were at 13.4% coverage. Chinese physical imports were at 8-year highs. The AI infrastructure silver demand was accelerating. The gold-silver ratio was still signaling dramatic undervaluation. Every single structural argument for silver was intact, and in many cases strengthening. But the Iran inflation trap was preventing the price from moving to reflect that structural reality. The price was being held down by a temporary monetary policy headwind that had nothing to do with silver's fundamental supply and demand balance. Today, that headwind was removed. And what you're watching in silver's 6% move through $77 is not a new bull market beginning. It is 10 weeks of pent-up fundamental repricing releasing in a single session. The coil that had been compressed while the inflation trap held is now unwinding. And the question for every silver investor right now is not whether to participate in this move. The question is how far this repricing has to run before the 10 weeks of suppressed fundamentals are fully reflected in the price. Let's do the math on what silver's price should look like once the Iran inflation premium is fully unwound from energy markets and monetary policy expectations. Reprice accordingly. When crude oil falls back from conflict-elevated levels toward its pre-conflict range, the inflation expectation component that was keeping Treasury yields elevated begins to compress. Compressing Treasury yields mean nominal rates moving lower. Lower nominal rates against an inflation backdrop that, while still elevated, is no longer being fed by an ongoing energy supply disruption. That combination produces lower real yields. Lower real yields are the single most powerful driver of silver prices over any time horizon longer than a few weeks, as we documented in exhaustive detail in our real interest rate indicator video. The quantitative impact of the real yield compression that should follow today's Iran deal on silver's price is not trivial. Each 25 basis point decline in real yields historically corresponds to a meaningful percentage move higher in silver. The total potential real yield compression from today's development, if crude falls back toward pre-conflict levels and rate cut expectations rebuild in response, represents a silver price catalyst that is measured in double-digit percentage moves, not the 6% we saw today. Today's move is the opening payment. The full repricing runs considerably further. Here is something that is happening simultaneously with today's Iran deal news that most silver coverage is going to completely miss because it requires connecting dots across different parts of the silver market simultaneously. The COMEX May delivery cycle is still actively playing out. The registered silver inventory coverage ratio is still at 13.4%. The physical supply stress in the COMEX system that we have been documenting across multiple videos has not been resolved by the Iran ceasefire. What the Iran deal does to the COMEX physical picture is actually complex and in some ways counterintuitive. Lower crude prices and reduced inflation expectations might suggest less urgency for hard asset accumulation, which could theoretically reduce physical delivery demand. But the other side of that equation is what happens to rate cut expectations and institutional silver positioning when the Iran inflation trap is removed. When institutional investors who have been sitting on the sidelines of silver, waiting for the Iran-driven inflation headwind to clear before adding precious metals exposure, get the signal they have been waiting for. The inflows into silver ETFs, silver futures, and physical silver that follow can significantly amplify the physical delivery pressure rather than reduce it. The removal of an inflation headwind is not a reason for institutional precious metals investors to sell. It is a reason for the ones who have been waiting to buy. An institutional buying flowing into a physical silver market that is already running at 13.4% COMEX coverage is a combustible combination that today's Iran deal may have just lit the fuse on. Let's talk about the Kevin Warsh dimension of today's move, because the Fed chair transition that is happening this week, with Powell's term ending May 15th and Warsh's full Senate vote expected any day now, interacts with today's Iran deal in a way that is specifically silver bullish and that the market is beginning to price. We established in our recent analysis that Warsh's hawkishness was one of the two primary factors, alongside the Iran inflation trap, that drove silver from $121 to $73. The Warsh shock of January 30th was predicated on the assumption that his tenure would keep rates elevated and delay the rate cut timeline that precious metals needed. But today's Iran deal changes the calculus for Warsh in a specific way. The primary argument for keeping rates elevated under Warsh was the inflation threat, specifically the Iran-driven energy inflation that was feeding into core price measures and making rate cuts premature. If crude oil falls back toward pre-conflict levels because the Strait of Hormuz is reopening and the ceasefire holds, the inflation argument for rate hold weakens materially. Warsh himself has stated he prefers the Dallas Fed's trimmed mean PCE at 2.3% over official core PCE at 3.0%. With energy inflation coming out of the equation, both of those measures move lower, and the trimmed mean, which Warsh trusts more, potentially moves toward a level where rate cuts become defensible. Today's Iran deal did not just remove the inflation trap that was suppressing silver. It removed the primary justification for the hawkish Warsh monetary stance that was the other leg of silver's suppression. Both legs of the bear case just got kicked out simultaneously. Silver is repricing accordingly and has a long way still to run. Now let me address the risk case with complete honesty. because intellectual integrity requires acknowledging what could make today's move a false breakout, rather than the beginning of the full structural repricing. The primary risk is deal deterioration. A ceasefire framework is not a permanent resolution. Iran has walked back from preliminary agreements before. If the negotiations that are supposed to follow today's ceasefire break down, if Iran resumes blocking the strait, or if the U.S. re-implements maximum pressure measures that reignite the conflict, the inflation trap snaps back into place. Crude surges again, inflation expectations re-elevate, and silver gives back today's gains. That risk is real, and it is why position sizing and risk management discipline matter even when the directional signal looks as strong as it does today. The second risk is Warsh himself, specifically the possibility that even with energy inflation coming down, Warsh takes office and immediately signals a more restrictive policy stance than the market has begun pricing in since this morning. A hawkish first press conference from a newly confirmed Warsh could counteract some of today's move. The third risk is the COMEX physical dynamics delivering a disorderly outcome that generates volatility in both directions rather than a clean repricing. These risks are not reasons to avoid silver exposure. They are reasons to structure that exposure intelligently, to hold a position sized for the structural opportunity while maintaining the discipline to manage through the volatility that will accompany even the most justified moves higher. Here is the trading and investment framework for how to think about silver from $77 after today's 6% move, because the question every silver holder is asking right now is whether to add at these levels or whether today's move is so large that the near-term risk-reward has shifted. The framework comes back to the fundamental gap analysis we developed in our $73 structural bomb video. At $121, silver was pricing in the full structural bull case with all catalysts aligned and active. At $73, silver was pricing in the complete suppression scenario. Both legs of the bear case simultaneously active. Speculative positioning cleaned out, fundamentals ignored. At $77, with one of the two suppression legs just kicked out, silver is beginning to reprice toward fair value for a structural bull market with the Iran inflation headwind removed, but the Warsh uncertainty partially still present. The fair value calculation for silver in an environment where the Iran conflict is resolved, where real yields are declining, where the gold-silver ratio is compressing, where 6 consecutive annual deficits have drawn down above-ground stocks by 762 million ounces, and where AI data center demand is adding a new accelerating demand layer, that fair value is not $77, it is not $90, it is significantly above both. Today's move is not the moment to chase recklessly, it is the moment to position thoughtfully for a repricing cycle that has 10 weeks of accumulated fundamental undervaluation to resolve and multiple additional catalysts on the near-term horizon that will drive it. The inflation trap has been detonated. The 10 weeks of suppressed fundamentals are beginning to release. Silver ripped 6% through $77 today, and the structural case for where it goes from here is stronger than it has been at any point since the January all-time high. The supply deficit is larger. The COMEX coverage ratio is more stressed. The physical import data from China is at 8-year highs. The AI demand acceleration is locked in and growing. And now, for the first time since February, the primary monetary policy headwind that was preventing all of those structural realities from being reflected in the price has been removed. The coil is unwinding. The question is how far it runs. And based on everything the data is saying, based on 5 decades of precious metals market history, based on the current physical supply reality, based on the ratio dynamics, based on the real yield trajectory that today's deal has set in motion, the answer is considerably further than where we are right now. Leave a comment right now and tell us, were you positioned in silver before today's 6% move, and how are you thinking about your exposure going into the sessions ahead now that the Iran inflation trap has been detonated? The conversation in this community around exactly these inflection moments is always the sharpest analytical discussion anywhere in the silver investing space, and we want to hear your read right now while the move is live. And if you know a silver investor who sold their position during the decline from $121 to $73 and has been sitting on the sidelines watching today's breakout, share this video with them immediately. Because the best time to understand what is driving a silver move is before it has fully run its course. And this one is nowhere near finished. We will see you in the next one.